Hey everybody, welcome back to the show. So today we're going to walk through the One Big Beautiful Bill Act. I think I got that right. And look at the more significant tax changes that it's brought us. We're also going to talk about some things that haven't changed. And then we're going to look at how this might impact us, particularly for those sort of thinking ahead, retirement or in retirement. How might it affect Roth conversions? How might it affect tax gain harvesting? So we'll look at that as well. And again, as always, everything I show you on the screen, I will link to below the video. And I've got a cheat sheet for us. I included this in the newsletter that went out Sunday morning. If you don't subscribe to that, it's free, goes out every Sunday morning, and you can subscribe with the link below this video. This comes from our friend Andy Penko. He's been on the show before, just an incredibly smart guy, a lot of experience with financial planning. And he put together this PDF that I'm going to walk through. And again, I'll link to this below the video. The one thing he pointed out to begin with, and I've highlighted, these are my highlights, but he pointed out that there are no changes to how Social Security is taxed. And this was sort of an important thing to point out because there had been some talk about, maybe eliminating taxes on Social Security. That did not happen. There are absolutely no changes to the way Social Security is taxed. There is a $6,000, some call it a bonus deduction that we'll talk about in a minute. The other thing I'll point out is that there were no changes to retirement accounts, at least not directly. There were no changes to Roth IRAs, for example, or IRAs. I had seen some folks, including on YouTube, saying that the backdoor Roth and mega backdoor Roth IRAs had been eliminated. That is incorrect. There were no changes to those sorts of things at all. Again, no direct changes. As we'll see, so many of the changes that are in the bill could affect things like Roth conversions. That's more of a strategic thing. We will talk about that. So let's walk through it. Now, what I've tried to do is highlight in red things that might cost us more money and highlight in green things that might save us some money. So the first thing, if you use the Affordable Care Act and credits, there were some what they called enhanced credits that were brought in as a result of COVID. They originally came into effect 2021, and they were set to expire a year later. There's sort of this short-term benefit. It removes some of the phase-out cliffs where $1 more and you lose a lot, and it also increased the amount of credit you could get. Those were extended in 2022 under the Inflation Reduction Act, and under the current law now, they are expiring. So again, this is where there's been some misinformation. I've heard some people say the Affordable Care Act credits are going away completely. That's not true. The enhanced credits that were designed to specifically address COVID, they are ending. And again, you can read more details if it's important to your situation in this document, which I'll link to below. As you probably know, the reduced tax brackets that came into effect back in 2017, the 2017 law, were set to expire at the end of this year. They are now made permanent. I should put permanent in air quotes. What that means is under current law, they're not changing. Of course, we all know a new Congress, a new president can change anything in the tax laws. So how long these will actually stay in effect, well, your guess is as good as mine. But at least for now, they are part of the permanent tax law, meaning they're not set to expire at any point. That puts the top bracket at 37%. Keep in mind that the income that moves you into each of these brackets does change from year to year. It's adjusted for inflation. All right. Next, permanent extension of increased standard deduction and an increase to those standard deductions. So they sort of did two things. These standard deductions tend to go up by a rate of inflation. There was a bump this year. They were set to expire, but they're not now, and you can see here what they are. So if you're single, $15,750. If you're married, filing jointly, $3,150. Again, that doesn't include some other deductions that we'll look at. In fact, actually, the first one is this one. If you're 65 or older, you're still getting, for singles, $2,000 deduction. And up here, you'll see if you're married filing jointly, you each get $1,600. Again, if you're both 65 or older. That underscores another aspect of this legislation. And it's not new, but there are marriage penalties. And this is an example because, again, if you're single, you get $2,000, right? You see that here. So you would think, okay, well, if I'm married and we're both over 65, we should get $4,000, but that's not how it works. You get $1,600 each or $3,200. So some call that a marriage penalty. I guess it is, right? If you got divorced and you filed separately, I guess you get each $2,000, but of course, you then change the tax brackets that your taxes get hit. You'd be filing under the single. So in some cases, you're quote unquote penalized for being married. Sometimes you're not. You're penalized for being single. I don't know how it all comes out, but in any event, that's the law. All right. And then this personal exemption, sometimes we call it a deduction. Practically speaking, it's the same effect. This is the $6,000 bonus, as some call it, bonus deduction that you can get if you're 65 or older. Now, it's temporary. You can see here, it only lasts through 2028. So this is not a permanent exemption. Whether it will get extended, again, your guess is as good as mine. A couple things to keep in mind. You get this even if you can qualify for this even if you itemize your deductions. That's number one. Two, there is a phase out. So if we come up here, you can look at the way the phase out works. But there's a phase out that starts at $75,000 for singles, $150,000 for married couples. That's of modified adjusted gross income. So these do phase out. And Andy was kind enough to give us some charts here. I'll just skip over it. You can see for a single taxpayer, it starts to phase out at 75. It's completely phased out at $175,000. And if you're married filing jointly, 150 phases out at 250. So a big potential benefit. You're married. You're both in retirement, maybe above. If you're 65 or older, it's potentially a $12,000 reduction in your taxable income. Again, we'll talk in a minute strategically what you might do with that benefit. Of course, you could just pocket it, say thank you very much, and enjoy the extra money. But there may be some other strategies. But again, it does phase out and it does end in a few years. So keep that in mind. This one may not apply to many people, but I'll mention it because if it does apply to you, it's important. There's this whole lifetime estate gift tax exemption, and it had been increased with the old tax law. That increase is now permanent. Again, can be changed by future Congress and president, but under current law, it's permanent. And in 2026, so normally this is going to go up by a rate of inflation, but it gets sort of a little extra bumps in 2026. You can see it right here, $15 million per person. So if you're married, depending on how you handle your estate, and this is where you want to talk to a trust and estates lawyer, you could each benefit from that $15 million. Keep in mind that if your estate gets hit with estate tax, I think it's 40%. It's a big number. So this is pretty significant. Again, I get it. Doesn't apply to most of us, but if it does apply to you, pretty important to understand that change in the law. There was a change to the alternative minimum tax, but I didn't really focus on that. They made permanent the extension of the reduction of the amount of residential mortgage interest to $750,000. Again, may or may not be important to you, but I'll mention it. And then a couple of changes related to, in this case, it's SALT, state and local income tax, state and local tax deductions. A couple more we'll look at in just a minute. The old law, from 2017, limited SALT, state and local tax deductions to $10,000. This one bumps it to 40, but one, it's temporary, right? Just through 29. That's the first thing. And the second thing is there's phase outs. So depending on your modified adjusted gross income, there will be phase outs for married filing. Actually, it's for both single and married filing jointly. This $500,000 limit applies to both, which I think is a little unusual. But in any event, you need to know there are phase outs. So that's something to keep in mind. And you can read details there. So I think once I think you hit 600,000, Andy says you phase out completely. This one, I think, so there's some changes to charitable contribution deductions that I think haven't gotten a lot of attention, but are pretty significant. The first one, they made permanent this idea that even if you have a standard, take the standard deduction, you can deduct a small amount of charitable contributions. You can see that there. But the bigger change, I think, is that starting in 2026, if you itemize your deductions, maybe you give a lot to charity, you could only deduct those charitable contributions to the extent they exceed 0.5% of your adjusted gross income. So that first 0.5%, whatever that is, you can't deduct it. And, Andy did some math here, which you can read. But that's important to take note of. This affects my wife and I. We tend to give, usually because of the whole SALT issue and other changes to tax laws, we've tended to take the standard deduction one year and then give some money to a charity. We use a donor advised fund the next. This change probably won't alter that strategy, but it will reduce how much we can deduct for the charitable contributions that we give. So if that's you want to take note of that. That's I think, a significant change. And I wonder if over time we might see future changes to this where they increase that. I don't know. That's just speculation, but I guess we'll see. All right, the next two, in my mind, kind of go together. That is, you can exclusion of tax a tip income up to $25,000, and there are phase outs, so keep that in mind. And then exclusion of up to $25,000 in overtime pay, also exclusions, same exclusions. I think the exclusions, by the way, for tips, the phase out starts at a modified adjusted gross income of $150,000. For single filers, $300 for married filing jointly. Tip income, I don't know how much that phase out is going to affect the exclusion for tip income. But for overtime pay, it might hit more people. We'll see. But keep in mind, there are phase outs for both of those, and they're both temporary through 2028 for overtime and also for the tip income exclusion. Those will expire in a few years. And then temporary deduction for up to $10,000 of car loan interest. Also, this is not an itemized deduction, separate category of deduction. And again, there are phase outs. And then the last sort of broad category, there are all these home improvement efficiencies, clean energy credits, and then the purchase of electric car. Those are ending. And so if these are things you've been considering, you've been thinking about an electric car, you might want to buy it before September 30th. Same thing with home improvements. They're effective end of the year. And then the last thing I'll mention before we sort of get into some some strategies to take advantage of some of this Trump savings account, kind of an odd thing in my mind, but for individuals under 2018, there's currently no end date to this. And apparently, I don't know how this is going to actually work out in practice. I guess we'll find out. The government will be making a $1,000 contribution for every child born from 2025 through 2028. So that part of it is, limited. The thing I found interesting about this is in the yellow here, I've got the investment options. The accounts will be limited to index exchange traded funds or mutual funds whose expense ratios are no more than 0.1%. So the OBBBA is a big fan of index funds, apparently. And so there's that. There's a lot of details there you can read if this is important to you. The one thing I'll point out is, and I don't think this can happen until the middle of next year, but you can contribute more beyond the $1,000 that the government throws in. There are, of course, limits to that. And the maximum annual contribution is $5,000. Adjusted for inflation after 2027. So I know I've kind of run through that fairly quickly, but those are some pretty significant changes. Again, I'll link to this document so you can read it for yourself. Now the question becomes strategically, particularly for those in or near retirement, what might we do with that? Well, the overall change, of course, is to lower taxes, right? We're going to extend the lower tax brackets, and then depending on your specific circumstances, you might get additional breaks, particularly if you're 65 or older. You can potentially qualify for that $6,000 per person deduction on top of the additional deduction you already get for being 65 or older. And then again, some of the other reductions like car interest deduction, for example, might lower your taxes even further. And that raises the question, well, okay, how do we play that? And so there are a couple of things to think about. So I will show you two things. Again, I'll link to both of these on the screen. The first one is, this is just oops, let me move me over out of the way. This is from US Bank. These are just some of the tables of tax brackets and whatnot that are now, in effect under the new law. The thing I want to point out is capital gains. So this is the capital gains tax bracket. I'll focus on married couples filing jointly. If you could see here, this is taxable income over. So let's imagine, first of all, that you had no ordinary income tax. You're retired. Let's maybe say it's even before you get Social Security. You're going to wait till you're 70 or whatever. But you have taxable investments, and you might trigger capital gains if you sold any of your taxable investments to live on. What this is telling us is the first $96,700 in taxable long-term capital gains is effectively tax-free. Now remember, you can actually generate more than that because you first subtract your standard deduction. So you'd subtract your standard deduction if you're married filing jointly. That's over 30 grand now. You get, if you're over 60, if you're 65 or older, you get that extra standard deduction plus the 6,000. And so you could be well over 100 and I think it's like 128,000, but it's a pretty big number that would be totally tax-free in capital gains. Now, the thing to remember is that if you have some ordinary income, the concept that I like to think about this is called income stacking. You first stack up whatever ordinary income, taxable income you have, right? And you could come up here and see how that would be taxed on these brackets. So let's assume you've got some ordinary income, you've already subtracted your standard deductions or your itemized deductions, and you have some amount of ordinary income left that's of course going to get taxed. Here are the brackets that would tax it. Let's just assume you've got 50,000 in ordinary income. And so it gets taxed according to this table based on, we'll just assume for the moment you're married filing jointly. And then you have some capital gains. How does that work with this bracket? So what you would do is you would take your capital gains. Remember, we assumed that after all your deductions, you've got $50,000 in ordinary income. Your next dollar of long-term capital gains, as we look at this table, would be, you'd think of it as $50,001, right? It would stack on top of your ordinary income, and from that point up, start to fill up these brackets. So that would effectively leave you another, 46,700 that would pay 0%. Because once you had that amount, you'd had $50,000 in ordinary income. Again, this is after all your deductions. And then let's say 46,700 in long-term capital gains that would be taxed at 0. That would bring your total taxable income up to 96,700. And then any dollar over that would get taxed at 15% until you reach this big number. And then dollars over that would be taxed at 20%. I hope that makes sense to you. The concept is just income stacking. That's a term that Wade Fowle came up with, a retirement researcher. Why am I going through all of this? The lower taxes that we have now under the tax law, including the extension of the tax brackets and all the new tax breaks, many of them temporary, could give you an opportunity to realize some capital gains at a 0% tax bracket, and that you may spend as part of your retirement plan or just reinvest with now a higher tax basis. That's one strategy you can consider. Now remember, let's say you sell $100,000 of an investment. That's not all long-term capital gains, right? It's only the gain portion of that. So you would subtract out whatever your cost basis is. So this can be a big benefit and something that, depending on what the tax laws do in the future, may end up going away. We may lose a lot of these lower tax rates. Again, we don't know, but I think now's the time to really think about whether we can take advantage of that. And then the second strategy would be to say, well, I could perhaps do some Roth conversions at these lower rates. Because remember, when we think about a Roth conversion, we're thinking, okay, what's the tax effect of converting that money now? What tax will I pay today in 2025 because I've converted some traditional IRA to a Roth IRA, for example. And then what's my best guess, and that's what it is, best guess, of what my tax liability will be in the future if I don't do that conversion and just take my money out of the regular IRA sometime years from now, either to live on or because the required minimum distributions force me to take money out, and compare the two and which one's the better deal. So yes, we've got to make a lot of estimates, some guesswork, but we do the best we can. And with these lower tax rates and all these deductions, it may give us some room to do some additional Roth conversions. I'll point out this resource. This is from the Ed Slott Company. Ed is sort of, I would say, probably the preeminent expert on IRAs and Roth conversions. This wasn't written by him, but someone on his team. And it gives some things to think about. These are basically just a summary of a lot of the new tax laws that we've already talked about. Here, I think there are sort of two things to consider. Yes, taxes will be lower. That can give you an opportunity to do Roth conversions. On the other hand, remember all those phase outs. So if we get carried away with our Roth conversions, it might increase our taxable income such that we phase out of some or even all, depending on how much we convert, of those tax benefits that we have, whether it's the $6,000 standard or personal exemption, technically a bonus deduction for those 65 or older, or maybe the interest on car payments, or again, depending on your situation, the overtime or the benefit, $25,000 in overtime pay that you don't have to pay taxes on, or the tips. So you've got to keep in mind those phase outs. Does it render the Roth conversion a bad idea? No, but it makes it more expensive. If the Roth conversion is going to cause you to lose some of those tax benefits, it's going to make that conversion today more expensive. And it could mean that it's not a good deal when you compare it to what you would pay otherwise down the road, either when you start taking money out for retirement or because of required minimum distributions. This is where I think retirement planning software can help you. I think all of the retirement software that I look at, and mainly the three are ProjectionLab, Bolden, and Prelana. I don't believe any of them have fully updated their code yet for the new tax laws, but they will. And so that's where I think sort of that long-term planning, you can really benefit from using one of those programs. Or, of course, talk to a tax expert or retirement planning expert, let them run the numbers for you. So I do think the tax laws changes do give us a lot of strategic options to take advantage of these lower tax rates now while they're in effect. And so we certainly want to be thinking about that. I know I've thrown a lot at you. It's a lot to think about. Hopefully this has been helpful. I'll link to everything below the video. Of course, if you have questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.